Well, I'm listening. Yeah, hey, sound check, folks. I was looking at CNBC here, and this guy from Guggenheim, they say, manages 265 billion. I like this statement he just said. I'm not sure what his conclusion is, but he said bull markets don't end of old age. They end when they get shot in the head by the Fed.
That's such BS, though, Dan. You know, maybe that's like the theme of the day, but you know what that really tells me is that these guys that are managing, how much money did you say?
268 billion.
$268 billion. And he is searching for a reason what's happening here and just regurgitating words from the past.
Let me just politely interrupt, and that's why I caveated it with saying I don't know what his conclusion is, because I can't hear him now, but he could be saying the exact opposite. He could be saying the Fed has not shot the bull market in the head yet, because we're nowhere near extremes like you were saying in MT Live. So that's what I'm saying. I don't know yet. I don't know his conclusion.
Okay. If you should hear it, I'd be interested, because.
All right. Well, let me hear it, because I mean, if they say, yeah, we're liquidating all our accounts, then yes, he's saying the Fed screwed it up.
Well, I don't think he's liquidating all of his accounts. No, maybe some positions, but the other day you said that you read that there were like 4 hedge funds that shut down, and that was before this happened.
Yeah, there were 3 shut down just this week alone, and then shoot, I'm trying to think of this other big one. Shoot, what is it? A top hedge fund guy. I could probably Google it, but anyway, they said he was down 25% this year. And I'm just scratching my head. How can you be down 25% unless you just are a contrarian and you're 100% in the wrong asset class? How can you be down 25%?
I don't know. You know, I can tell you personally, this move for me, and I've mentioned it, kind of blindsided me. I mean, I knew the market was correcting, wrote about it in the letter, but the extent of this move in the course of essentially a week, you know, just looking at the spiders here, because, you know, that's 5 days of trading, you know, from the high point, which started the prior week. But a move of this size, I mean, I'm kind of frustrated with myself. And like, one of the things that you have to accept is that you can't know everything that there is in the market. But, you know, I've been at this long enough and been able to take advantage of the majority of these kind of moves. And so even as long as I'm doing this almost 30 years, for me, I feel like I'm going to be searching this for a little while to kind of figure out why I didn't see the size of this thing coming. And, you know, what you said, you haven't gotten the conclusion of this fella yet, but I think, and based on the pattern that I'm seeing, is that this move started to happen, and just selling turned into more selling. And I'm not sure that anybody really knows why, other than maybe everybody just started to feel the market's gone up for too long and it was time. And who knows whether, you know, the tariff thing's been going on for months. So all of a sudden, you know, not the Senate thing, the Supreme Court judge. I mean, I just don't see that as being a reason. I don't, you know, maybe I don't understand the implications of that, which maybe that's in the back of my mind to say, but what's going to happen here in the moment or in the next few months related to that? Common sense suggests to me is 0. So what the hell happened here in the last 5 days other than the buyers started to get their butts kicked, and then everybody just said, hey, you know, what is this kind of saying? The emperor has no clothes or something? I don't know, you know? And so here we are approaching this 280 level, you know, the second part of the measured move happening or close to happening in one day, which I haven't seen that happen before either. So the market is always educational. And you can see, I just expanded this chart here, how prices are beginning to accelerate to the downside down there. Look at this is an hourly bar. And look at, you know, how it's growing, where this one started today. And this one, maybe we're getting close to the end of this move here. And I'm just going to flip over to a 5. And, you know, each time it tried to hold, even this breakdown failure right here couldn't bring in the buyers. Well, here you had probably some shorts that sold a breakdown that got caught, and it retraced, and then the sellers were right there at that resistance, and back down it went. So,
yeah, excuse me. Yeah, I didn't hear him, but I'll Google him later. Just one other thing though, to answer your other question, I in terms of the hedge fund, I think it might have been David Einhorn, who runs Greenlight Capital, in an article on CNBC, July 31, August, September. So this is, you know, just mid-year. This is 3 months later today. It said he had his second worst quarter, bringing his year-to-date loss of 18.3%. And that's of July 31. So I think that was the one they said he's down 25% now. Greenlight Capital. But let's talk about a couple other things, because, you know, whether it's market euphoria or fear, it's raising people's anxiety of either wanting to do something or fear because their positions are in pain, or, you know, one of two things are happening right now as the markets are collapsing, and it depends upon your bias. If you're short, you're happy as a clam and you're in management mode. If you're not participating in the short and like to short, then you're asking, you know, how can I participate? If you're holding positions that you violated your trade management and trading plan, and you didn't take your stops, then you're hurting right now, and, you know, your head's probably between your legs, you know, just saying, please let this go away and I'll never do it again. And that's a whole nother subject, if you really learn from that mistake or not. That's a whole nother subject. You know, we including me, I told folks I got chopped up. I've had a little drawdown here. Trade review of the trades we are in and given to our subscribers were quality, as always. We didn't expect this downdraft, although you have been dead on with your overall market comments about, look, these aren't in alignment, so trade lighter. And I definitely have traded lighter. And then in our Master Trader Live today, and every single morning in pre-market, we give the recipe, if you will, of what we are looking for to have a bias to the long side, because we're so oversold right now in the market internals, as we spent MT Live today going over in great detail, are getting really close. We wanted a sell-off. We're getting it. So unless you're just day trading short, it's not compelling to enter new swing shorts right now, of course, because things are oversold so much. So we're in this weird middle position right now. Like I said, a day trading short was fine. There were plenty of opportunities. I see Amazon down, you know, 82 points, etc. we spoke about iRobot today. It's a beautiful day trade short, IRBT, and there was many others. But so if we have some subscribers, like we're in the Master Trader Green Room right now, feel free to ask us questions. So I gave you different buckets, if you will, of feelings. Ask away. We want to help you, but in terms of, I think our game plan, what we're looking for is we're cautious as can be right now, waiting for our recipe of bullish internals to line up. So that's where we are. And the 80-20 principle is we make the majority of our profits when things are lined up, and we're extremely cautious preserving capital when things aren't lined up. So that I just threw a whole lot at you. So if you're subscribers, feel free to ask us anything. Greg, you can react to anything I said. We can talk about any other subjects.
Well, John is asking about interest rates and XLU, which I mentioned that, John, which was a little odd to me. I don't actually get it. I don't get why the market reacted as it did a day after interest rates spiked, after they went up this was the September low in interest rates right there, or just before September. It started up and was going up, and utilities did drop. And now all of a sudden, utilities are rising with rising interest rates, which, the correlation isn't exact, but.
Well, Greg, I can answer at least from, an article in the journal this morning. They were saying just with the market sell-off, it's a flight to safety trade. So they're, that's why Philip Morris, and, it's a flight to safety. And that's typically utilities and, healthcare and, whatever discretionary sectors are considered the quote unquote safety ones, but during market sell-offs. That was.
I get all that. And bonds are supposed to be a flight to quality too.
Correct.
And it's just the opposite of what's happening. That's why utilities going up and bonds going down, the connection is broke.
I hear you, and I do not have the answer, except so we're just talking, of course. So, we're brainstorming, and I did read another thing that maybe, and it was announced last week. So again, it's a delayed reaction if this really is the fact. But they're talking about when China announced a couple days ago that they were going to start selling U.S. Treasuries. So is that, whatever the market's interpretation of that is that going to be some unwinding process? Oh, maybe I read it in Barron's this weekend. And so that was an issue, and it was Barron's. And because then I also remember it saying that the U.S. Treasury, they've been in the bond decline business, because they blew up their balance sheet buying bonds to inject money into the markets over the past many years from the financial crisis. And they've been dumping $50 billion a month of their own bond inventory. So, that coupled with China and whatever other intermarket news and fears, so it is helping that bond sell off and interest rate spike.
Maybe, John's saying, is this just a spike and the smart money doesn't think rates will remain high? I think it would be foolish to think that based on the chart, because this kind of move, and as well as the economic news that's been coming out, which suggests that not only are they going to remain high, they'll probably go even higher. So I don't think, smart money is kind of relative to the market, because the smart money is still the same ones that are loading on options at the worst possible time that moves those to an extreme. And smart money is going to be the people that are going to create the wide range climactic bars at the lows and the highs. It's not day traders. Right? So, the smart money is smart as long as prices are trending in one direction, because they hold on and add to things as long as it's working. Pat is of the opinion that the market is manipulated because of the midterm elections. And of course, I think there could be market manipulation, but on the other hand, who has that much money to make this many stocks and the market go down at one time? It isn't George Soros, maybe a billionaire, but he can't move the market more than a very short period of time. And, so who has this much money? If we wanted to go to that kind of a thought, it would have to be a unified effort of governments, because the governments are the only ones that have that much money, and if they could join together to make, remember, this is 5 days, right? 5 days of a move in the markets. 1, 2, 3, 4, 5. Before that, it was just going sideways. And
exactly.
the Qs made a new high. Right? It was a new all-time high. The Dow made a new all-time high. So to fall apart in 5 days, it's highly unusual. So it looks like it's it's not looking, it's getting close to this low point here. And so far, looking at the 5 minutes, just, short-term stabilization within the downtrend.
But say, Greg, but if you look at the daily, this is related to the question I was, or statement rather, making on our MT Live. At the other multiple times in the year where the spiders gave us a compelling bullish pattern, with the market internals giving us a bullish joint uniform signal, was a whole lot easier than right now. For example, I mentioned at the end of June, it was just breaking out from a 2-week consolidation on the rising 50. I mean, that was a no-brainer time for a pattern on these spiders. Today, unless we get that full measured move down and then maybe drop down to an hourly to get, a double bottom and break the downtrend on the hourly, looking at this daily chart, a wide range bar down after a 2-bar consolidation, that still looks ugly to me. There's no compelling pattern that I'm looking at right there.
Oh, not yet, of course.
Right. So that's my point, that what flavors, and we don't know yet, because I'm talking in the future of what flavors of bullish pattern might set up. I'm just, my point is that it's unless it happens and they build a base with bottoming tails and a breakdown failure over a couple of days, then I'm more uncertain of what the setup is going to look like.
That's why we have different scenarios, right? So right. The setups happen in different ways, and it's always, the same. Meaning, the way prices came down here, we know they're not going to turn and rip back up to the highs. Guaranteed. If tomorrow prices were to gap down to the 200 MA, buy a 5-minute or 30-minute high and look for a day trade to short-term swing trade. You get a reversal, over a couple of days. We had this discussion yesterday about multiple time frames where you get some kind of stabilization where the hourly chart starts going sideways. Right? We had a lengthy discussion on this week. Starts going sideways, bigger move. Now this came straight down. Historically, what happens? Right? Once you get down to wherever in our internal setup, you get a short-term move, you get a retest, you get a W, you get away from here, bigger move coming. If it goes down, right? Let's say it goes down. Let's clear it up. And we're saying, okay, this is a nasty crack, so on and so forth. How do I short it? It goes up, has a decent retracement up. It still doesn't get up here, and it forms a double top, and you short it. So the recurring patterns stay the same through history. The one that will set up tomorrow or over the next week or so, I don't know, but I've got a library of them in my head, and that's what I talk about pre-market during the day. The different patterns that we're going to look for. So those are the scenarios. Which one sets up? I don't know, but when it does, I'll know.
That was my point. I mean, if you want, why don't you scroll back on the Spider daily and let's look at what the patterns were when they did trigger throughout the year. Like we had February, March, April, June, we just talked about.
Sure.
Because so that June was a no-brainer, early July.
So this was a nicer, bigger bottom now. And I believe the internals were set up there. I mean, and they were set up. This was a nice uptrend. So, is much, let's say, not so much easier, but, these kind of setups in a nice uptrend where it's rising above the 20 like that and the 20s above the 50. Whereas this type of deeper correction, this is ideal in that it took multiple days to set up. And then the bottoming tail that closed at the high was your, press the button when it triggers above there. Whereas this setup right here is more difficult, meaning that, it was sideways, it gapped down. The immediate recovery is like, okay, bulls are in control. And that happened after the big bottom. So that makes sense. So the understanding of this pattern happening in relation to this makes sense. Whereas this happening up here is not the same picture and interpretation. So, it's the same thing as saying, hey, how does a bottoming tail bar form? Is it in an uptrend like this? Is it a downtrend? Is it been going up and up? And now you got a bottoming tail bar, which would happen after a climactic move higher, which you don't look, it's still a bottoming tail bar, but you don't look at it as a bottom because it's already climactic. So it always starts with a bar that results, bar by bar analysis. What does this suggest to me? And what is the trend and the internals? So ideally, this kind of a collapse day, it's great. The bigger the gap down, the better, if that was to happen. And if it opens higher and the 5, and let's say after 30 minutes, it can't go up, or if it has a topping tail bar within that, that may result in another ugly day to the downside. And so at that point, we start looking at the NYSE tick. Do we getting extremes? Is there a divergence on the tick intraday? And so on the 5-minute, we may see this picture. So the same pictures happen in multiple time frames. Now, what we need to do is put together those multiple time frames and get ready for that to happen as it unfolds. Now, I'll come back to, I knew that this was in a corrective mode at that time, the breakout failure, but none of it suggested this at the time, and so now I don't like missing a move of this size. But it did come out of nowhere, so to speak, in that, going back to, what happened in the bonds. And if there was manipulation, which Pat suggested, that if somebody or any entity was able to do such a thing, my God, were they masterful at it. And the reason I say that is that, I said this in commentary and even wrote it in the letter, is that when I saw this happen as it broke above the highs, and by the time I broke above the highs, it was already a decent sized bar. And I'm looking at what's happening in the markets that day. And, the Q's just backing off from, the area of this high. And it's like, the markets don't care. It's weird, but okay, it's just going sideways. And then all of a sudden it just falls out of bed. So the markets will always do something that you don't see coming at times. And that doesn't happen all that often for me, but this one certainly did. And, I'm saying it because if I didn't see it coming, I think a lot of people didn't see it coming, except for whoever was able to pull the strings on this, if that's even a possibility. And I think the extent of this move is because money managers didn't see it coming. And now all of a sudden, that's what I said, the selling just resulted in more selling. And now we've got this extreme move. So we're back to, looking for the patterns that now would set up a retracement, because any downtrend always has a retracement. And you look at, how things set up at that time as to, can it retrace when it begins to bottom out here? So on the 5-minute, that's exactly what was happening. It was bottoming out. And then when it didn't go, right, it fell. Right? Dan talks about these things that I say, a Capraism, in that sometimes prices go down because they didn't go up. And that's a perfect example. And as is today, whereas the daily chart up above was saying, hey, maybe a bounce up to the 50 MA, the green line, to sell it short, and it didn't go up. So now it went down. And you know very well that based on those prior 2 days price action, that there was buying going on, looking for the bounce. And when that didn't materialize, it resulted in today.
And it looks like they're making new lows right now.
Yeah. So, it looks like the 200-day on the Qs, it should be a magnet, and that 170 level down there that's in alignment with the prior low, I think would be what sets up a buying opportunity tomorrow for at least a bounce. And you can be rest assured that a lot of these fund managers have their eyes on exactly that spot down there to buy. So that is my thoughts for the plan for tomorrow. If it gaps up tomorrow, it's going to have to be a huge one to suggest any kind of a move up. Any kind of a small gap up is probably a trap.
Yep. I just when you talk about fund managers, I recently read something that like 75% of mutual funds are underperforming the SPY this year.
Well, my understanding was they do that every year.
Yeah, they're pretty bad, particularly after their management fees. It's so much easier just to buy the spiders and then use, of course, master trader technical analysis and strategies to just trade spiders yourself on if you're a long-term investor, then the weekly and monthly charts. like we do in our ETF trader.
Yeah. You know, the other night, I was at a Skype call with the woman that is the developer for our backend software, Dan. And so she's explaining to me something, I forget exactly what it was anyway, which is kind of like brain damage for me. First of all, she talks about 100 miles an hour. She's so smart. It's like, okay, to keep up with her, you know, and what she's talking about, basically I'm at a snail's pace. So, you know, I'm telling her, you know, about what she's showing me. And she says to me, so Greg, what exactly do you do? I explained to her and she's like, oh, can you tell me where to put my money? And I'm like, whoa, let's not go there anyway, you know, because, you know, she's not involved in the market in any way or wants to be actively like we are. And so I told her what you were saying, Dan, about just spiders. And I said, look, and this is what I've told everybody over the years that asked me, where do I put my money? And I know they're not going to put in the homework, you know, to be active like this. I tell them all the same thing. Dollar cost average into spiders and Qs. And
provided they're in an uptrend, right?
No. Long term, you dollar cost average because the market will go up over time. You know, it's going to be corrections. And I told her exactly this. I said, if the market goes down big in a month, you add more than what you normally would.
But that doesn't sound like you talking. What about the bear market, you know, in March 2000?
Hey, as long as you're not 80 years old, you'll live through it.
Wow, that doesn't sound like you.
Well, that's me.
That's
my philosophy.
I would say as long as the weekly and monthly are in uptrends, or even if you want to say not even the weekly, the monthly, as long as the monthly's in an uptrend, do that. Otherwise, don't. And or you better have some aggressive covered call strategies, you know.
Well, yes, covered calls would be, you know, fine, but she's not of, you know, a level of understanding to suggest something like that to her. So for somebody that wants to be in the market, right, it makes sense. And it doesn't matter if the monthly's in an uptrend, because by the time the monthly's in an uptrend, you will have missed a huge part of the move. So as long as you're using money management, you've got an income where you can add more and you don't need that money to pay the mortgage, just deal with it. You're not going to be on the street. Yeah. Well, there's something else. That's an old alert. I don't remember it. HRL. Obviously, it must be going.
Yeah, these swing stocks are.
I was looking to get a pullback, and you know, today it's ugly. And you know what? Look at my VZ, which now I'm thinking about: should I sell it? This is what happens in a disgusting market.
Yeah.
This looks awesome this morning.
It's like a
profit. Yeah. Now I'm holding a loss. What do I do?
Morse has a big old tail. That was a defensive play.
Dan Gibby, what do I do? Yes or no?
What's your question?
What do I do with this?
Wait, is it a swing trade?
Yes.
Okay, so I would say it's at support. You know me, I would sell a call against it. And that selling a call lowers your cost basis. In fact, I've done that on some of my own positions already. I have a, you know, I've been in this XLF. I have a short strangle, which is a short put and short call simultaneously. And as XLF has been falling, I've been selling more calls against it, you know, so I can sit through this pullback. I sold the $27.50 at the money calls on XLF, took in 45 cents for 9 days. That's 2% return. And I mean, I'm actually short 3 times the amount of calls to put. So
that's an interesting point in that and I didn't think of this, meaning exactly what you said.
You could have got a much better entry, but here, let's look at some prices on it.
Well, let me finish.
I mean, it's volatile.
Let me finish, because I don't want others to miss this point.
Go.
Is that, look, if we assume that this thing's going to go down, which it might, I've share sized it for under yesterday's low, give or take, whatever. Now, what you said was sell a call against it. Fine. So I thought, okay, 56 from the point of view of, if it went up. So I looked at 56 and, it kind of like, it's not worth it. Even for 9 days, 25 cents doesn't make sense to me. But if I was to sell a $54 call, that's $1.16 at the midpoint.
But that's correct. And when you select the strike, you have to have a bias on where do you think it's going. And in selling in the money, you're correct. It has 63 cents of intrinsic value. So the difference is extrinsic value. So what I kind of like better, unless you think it's going to go down that far, but if it went down that far, then the trade's really busted and I don't want to be in it. So I would recommend 9 days, 54.5 for 85 cents. So it's 14 cents in the money, not 62 cents in the money.
Mm-hmm.
But yeah, I mean, I hear you. But yeah, I agree. Your stop has to be under yesterday's low, or then it's ugly.
Right. And so going, our pattern conversation is one where this is a victim of today's market. Right? It's one of the strongest stocks that was out there during any part of the correction. Sometimes the strongest ones are the ones that get clobbered at the end, and this could get clobbered. However, if, say, the market turns tomorrow, or let's say it even closes today, which seems really extreme, but let's say that the Qs and spiders get down to the 200-day moving average by the end of the day here today. I'm of the belief that the market would go up tomorrow. However, that might set up, and this topping tail bar would be ignored.
If you're saying if the spiders go all the way down to the 200,
and this survived without going down and hitting my stop.
Oh yeah. I totally follow you, but my point is I'm doing the math in my head, and that means the spiders falling another $4 now.
Well, I wouldn't have thought they'd have fallen as much as they did today.
No, but if so, then I 100% agree with you. And if they close at the dead low, and you and I have been trading together over 20 years, and I remember we used to do a similar tactic to the following. If they just kept puking into the close and they sold off another $4, which seems unreasonable in light of 44 minutes to close, I would sell out of the money puts on the spiders. I promise you that. Because then the VIX is even going to go through the roof up to that next level. We showed an MT live, and even selling puts for Friday, I guarantee you we could sell them like $5 out of the money, and they would be juicy as can be.
Well, let's see. I promised everyone, well, some that were in the room. In MT live. Gordon is not here. He had asked me, but I set up these bands here because I didn't remember how I actually set it up, but that moving average is pushing up there. This is always behind E-signal a little bit.
So yeah, I'm just looking at
100-day moving average, which is what I said. They want to know how these bands were created. It's a 100-day moving average of this pink line with 10 and 20% envelopes around it.
So I'm going back to my subject. So the puts that are $5.30 out of the money right now for 2 days to expiration are 87 cents. And so if we sell off more, the implied volatility is going to rise more, and these are going to get even more juicy.
Sounds like a steak.
Well, you know what? Even though I'm saying 85 cents, and that sounds like a lot, when the VIX was at, the VXX was at 60 in February. Do you remember, Greg, you and I and our subscribers who followed our recommendations? We were selling these out of the money put spreads that had 1 day to expiration, like $12 out of the money. And I remember because I was in the trade. We sold it for $1.79. $12 or $15 out of the money. It was insane premium. And those are the times where you, just like we said in MT Live, you have to have confidence in what you're doing. And when those line up, why would I want to buy the spiders other than you're going to get rewarded if you're right? If I can do a 10 lot of that, it's $1,800 in 1 day, and the thing can fall $12 further down. It's like a kid in a candy store when I see things like that. But the momentum is definitely down right now. That's for sure. Yeah, Pat, what I was saying there, because Pat was back on your Verizon thing, she was saying buy a put, and that's totally not my style, because number one, what put would you buy? And number two, it's going to cost, you're paying inflated prices for those puts, and I'd rather just get out of the trade, because when you buy puts, it raises your cost basis. Selling a call against it lowers your cost basis. So I personally am not a believer in that, unless I was, managing a hedge fund, and then I would do a combination, maybe collars, which is selling out of the money calls, taking that money to buy out of the money puts. So then you're giving up a little bit of the upside, but you're protecting a catastrophic drop. So I am a believer in collars. And it's not a dog collar, it's a stock collar. Alex, we're soon, Alex, soon. That's exactly what we're looking for. And I like the name of that. Pat's always coming up with good names for us. Like she came up with the juice bar, like that, and many others. But I like that. So we're gonna when Greg's scanning, we're gonna say, find us a candy store trade, Greg.
Yeah. And Jeff asked him, I mentioned this spread down just before MT Live, 287. He did the 287, 290. And he said it was at 9 cents here. Maybe it's a little bit more than that now, but I would pocket the money. I mean, the 280 was the initial downside target. So,
yeah, I would too. Absolutely. Why not? I would love another $4 drop in the spiders, and Greg knows you'll never hear me say that'll never happen. I know some people do, but I think it'd be highly unlikely. But anything can happen in the market. We have no idea. None.
Right. I mean, Alex, the whole conversation about hourly basis, we're not going to do anything until at least we got a 5-minute base. Nah.
Oh, that Home Depot is the only Dow 30 green stock up 27 cents, and that's still an ugly engulfing bar. Look at Home. Wow. I mean, in September, it was looking very nice. And now a victim of the market again.
Yeah.
Alex, no, the answer's Alex is saying, are we catching a falling knife? Absolutely not. That's what we spent 10 minutes earlier discussing the pictures that were of bullishness that we're going to look for before we engage. A 5-minute red bar in a nasty momentum move down is not that picture at all. So the answer is no, we aren't in the business of catching falling knives. We are in the business of trading climactics, buy and sell setups, but we have a defined method on how to do that by dropping the smaller time frames. But spiders right now, yeah, it's just a green bar. You know, it hit the 280, like Greg said, so that was a reference point, well, almost 2 reference points of prior lows on the daily. And, you know, we're some profit taking here. I'm sorry, profit taking on the shorts, which is, you know, the green and bottom fishers. You know, you don't know the motivation of somebody for buying, either covering or it's a new speculative trade. It's one or the other.
This kind of a pattern suggests that they're probable to be more downside tomorrow. And this could be an inside day, but, you know, FDN, not at support yet. Let's look at some of the SMH, close to support. Qs, I think the 200 is calling. The transports sliced through the 200 like it wasn't there. So this low down here, I don't know. That seems pretty extreme. But, you know, look at things in areas. It makes it a lot easier. You know, so we know we're getting, we should be close to a low. Aerospace and defense, ugly, looks lower. Clearly, airlines are being destroyed. IBB is on the 200, a little bit of price support. Consumer discretionary, 200, down there. So a peekaboo under the June low would make sense. Russell, spiders. Just holding that initial area there, probably the 200. Managers, fund managers tend to look at the 200 as a magnet and where to buy. The Russell looks terrible. Diamonds down on some support here. The extent of the measured move has been had, so we'll see there. Materials just destroyed. I'm looking at this, and the first thing that thought came to my mind was potential breakdown failure. We'll see tomorrow. I know it doesn't make sense, but it's not a big bar. It poked under it, and relative to what's happening in the broader markets, this is actually showing a little relative strength, which sounds unbelievable, but just look at the percentage change of these ETFs here. It's down less than 2%, and that's why it's at the top of this percent change list. It's down less than the others. Home builders got destroyed first, so that's holding a little bit. And home construction, same story, meaning it was already crushed, so it's holding here a little bit better, but still none of these are green. Now you can even see the year-to-date change. That was down, right, almost 24% already. So,
hey, Craig, when you're done looking at sectors, let's look at some pot.
yeah,
A number of these cannabis stocks I'm watching are the relative strength for darn sure.
Yeah, they are.
Start with Michael Juliet, the sector. So we have 2 tails now over today's high I like that.
Yeah.
Tilray, T-L-R-Y, Tilray.
I have the whole list right here.
Oh, cool, cool. Yeah, yeah, let's go through them. And then also this one that I mentioned pre-market, it's a Chinese
Oh, look at
electric.
that. How about that? Crone looks good.
Yeah, but I know it's a different sector, but when you're done with those, check out Neo. Um, yeah, Kron, yeah, beautiful bottoming tail. And hey, that has options. Pat, that's your favorite, right?
Yeah, Tilray looks pretty good. Potential for tomorrow. Hourly is shaping up.
Yeah, he's in the sector of Michael Juliet.
That's fine.
No, right. I'm saying I think I'll just stick to Michael Juliet first. You know, that bad boy. Unless we do a put spread because he's very juicy.
Oh,
Yeah, Pat, I'm looking at
I'm
Kron
going
right
to look
now
at this
too.
one tomorrow on my little chart here, and this thing could be a $5-10 move.
Yeah, without a doubt. Yep. Yeah, that thing can move. That is an understatement.
That looks good as a swing if it was to get above the high. All right.